All right, good morning, everyone. Let's get going. Okay, last night's session in the States was a bit of a non-event. It's weird. Yesterday we saw some real volatility in S&P futures. Yes, at least some decent volatility in the S&P futures in pre-market action. One point I think in the early morning, we were up as much as 7 points in the S&Ps. We traded down to about down half a point, went back to up 9 points, came back down. At one point we were trading down a couple points, I think, in the S&P opened. We traded down to about 5. So it was a really back and forth. It wasn't a big range, but quite undecisive in the early morning, and then we just drifted up from there. From the first half an hour in the States, from that point on, we really drifted up to 3 p.m. and from where we sold off. Not a whole lot of volume, not a lot of real leadership, but a consistent drift up. I think, to be honest, in the South African bull market case, the market that we saw at the States yesterday is not what you want to see, simply because we've been down 10 days in a row, and the States hasn't even taken a real sell-off yet. So I think that you almost want to see a washout in the States for a couple of days to get us to a point where you feel like we could put in a bottom here. Like I said, 10 days in a row here locally, I think that's the most, maybe the most ever on record, but it's definitely the most in the last 15, 20 years. And obviously, not no real days where we had a total onslaught, but a lot of just a couple 100-point down days in a row, starting to put a little bit of pressure on the index. We had a lot of data out yesterday. We had the Purchasing Managers Index in the States, which is better than expected. We had personal income, which also came in a little bit better than expected. Construction spending was also solid. But then again, we've been seeing a lot of weaker data that I think has been maybe on a much more important nature. This kind of back and forth in the data sets really kind of put some uncertainty into the market. We haven't really seen a real sell-off in the States yet, but in the States, but the global market has maybe gotten a little bit nervous in the fact that global economy is slowing down. All right, moving on into Asia. Most markets being down there, all the markets down. In fact, Australia really got hammered. I think rhetoric out of the central bank there today, not great. Expecting the further depreciation of the Aussie dollar. Basically saying that the economy is going to be under pressure because of how much reliance they have on minerals and resources and that sort of thing, which are really, really under pressure, obviously on the back of China. The rest of the market's also down. Shanghai actually coming down finally for the first time since they raised margin requirements, but still small in the scheme of things. And one of the things that I think is important is that South Korea, we have been talking about South Korea a whole lot. A lot of people call it the canary in the coal mine. You look at the Kospi there, simply due to the fact that they're one of those regions that actually does a hell of a lot of exporting. So usually when you start to see a real blip on their export numbers, it starts to be it's forward-looking in terms of demand from economies, and the export numbers there actually contracted quite significantly this past month. So I think that's something that's, I think, on the radar. It's maybe a little bit worrying that no one's talking about. All right, chart of interest today is showing NYSE margin debt versus that of the S&P 500, and you can see there the correlation is quite good. I did some reading on this yesterday, and I don't think this is as good of a leading indicator as maybe I thought it was, and it's simply because I think that the margin debt kind of follows around the S&P more than the other way around, potentially. And the reason why is if you look at margin debt, you can see that it's obviously been expanding the whole time, but in terms of a percentage weighting to the index, it's stayed relatively the same since 2010, I think, 2009 or 2010. So even though, yes, it's crawling higher, the S&P index is also crawling higher, so the actual percentage of margin used is not all that high. Now, one maybe alarming part about this is that as a percentage of GDP, the margin debt is at an all-time high at the moment, so that's interesting. All right, we got Mr. Price coming out today, expecting those numbers being at 2 o'clock. They already came out with a trading statement, obviously. We're looking for around 20% at 8.59. Revenue for 17.40 and divvy per share at 2.30 on Bloomberg consensus. Let's move into the market data for today. We've got Japanese monetary base, which is slightly better. We've got unemployment change out of Germany, as well as the unemployment rate at 9.55. In the UK, we've got mortgage apps and construction PMI at 10.30. Then we've got the CPI estimate in Europe, and then we've got U.S. factory orders today at 4. All right, let's get into the maps. Yesterday was really dominated by one thing, and that was the retail space. We'll get into that in just a second. But heavy selling in that index. Let's have a look here in the Aussie. 10 sessions down in a row. We've only really had 2 sessions with any sort of downward significance, but they obviously start to add up over time. There's some sort of support I would throw out coming in here in the long-term chart. So let's just look at this level. I remember when we broke out from here, this was a very big level, 45,500, big level coming in the Aussie potentially. We're going to look at this in a 30-minute. We showed yesterday, we showed this head and shoulder setup that we had dropped out of on as of the close on Friday. And you can see there, we bounced back up yesterday. We actually got through it a little bit in the beginning part of the session. I only could hang up there for maybe 15, 20 minutes and then very quickly failed that level. I think once we failed it, that was a really telling sign. And then you can see there we really dropped out the bottom. So the target on the breakdown of this head and shoulder is really about 600-700 points, and I think that puts us maybe around 45,900 on the index, which we're not very far away from. We're about 190 points off of that as we speak. So just keep that in mind. There's also major support at 45,500, which we just showed on the daily down here, and if we back out a little bit further into the 2-year, you can see how significant that level was. I mean, that was a real line in the sand at 45,500. So just keep that in mind. That's right around where the 200-day moving average is. I really think that might be a great little place that we can get a little bit of a bounce. And if you're a fibs guy as well, we can take this last move that we saw, and that would also put us down around 50% retracement from that move that we had off of these lows in the beginning of the year. So when you think about it and you think about how far we came and how fast, outpacing a lot of the other markets, this correction was always due, but it was, it's a matter of where we bounce off of. All right, moving on, let's look at ARI. The retail space. The mining space has obviously been under pressure. We're continuing to see a little pressure on. We saw big selling in Billiton and Anglos overnight. Billiton and Rio overnight in Australia. We can see we're right here at support in ARI. There's a lot of these charts that are still under real pressure, but this one, I think, if we drop this level, call it at $93, $93.50. Somewhere in there, you might even be able to call it 94. Once we drop that level, we can really potentially accelerate to the downside. And I think there's actually a relatively big target from there. Let's call it 94. All right, moving on, we'll look at the retail space. I'm just going to go through a whole bunch of retailers here. So one's Foschini, obviously dropping what I think is major support here around 175. Obviously on soft earnings. Really got things turning hard, but then the whole sector's been under pressure, and these are the only ones that have really, I think, came out and really disappointed in earnings. We've seen a real bump up in the 10-year Treasury or 10-year South African bond rates. We're up to 8.25 now, only from 8 about a week ago, and so obviously starting to price in a rate hike. That's starting to weigh on these guys as well, I believe. Truworths, you can see here, we talked about this level yesterday at 87. Obviously, we got below 87 in style. And really were hammered hard. I think that the target here is probably closer down to this 81 level, and also it lines up with some horizontal support, and that's probably around where the 200-day moving average will be in a day or two. So just keep that in mind. I mean, I think Truworths around 81 is probably getting close to the shorter-term bottom end of the range target. Next one we'll look at is Mr. Price, which has also been absolutely decimated and dropped out. day before yesterday, was slightly closed below support, and you can see there that it really bombed out yesterday. It was ugly. We're down 5%, Mr. Price. The problem is here simply that I think that the target's quite a bit lower. I mean, I think that we're looking at maybe 220 as our first target, the first little place. I think that there's real support. Not saying that it won't bounce up or at least retest these levels before, but that's, I think, maybe where it needs to get to really come in and find some real support. Clicks as well. We showed this one yesterday coming into the day. Dropped hard on support yesterday. Definitely a bigger target, much below the 200-day moving average is where the target we're going to look at. And then the last one we'll look at here is Woolies. So Woolies is also been hammered hard in a 2-day session. I mean, it maybe have taken some of the steepest falls in terms of a 2-day move. You can see in terms of Woolies, we've got trend support coming in down here around 90 bucks, or somewhere around 90 bucks there. I think that might be a short-term opportunity. I wouldn't put a whole lot behind it. Some horizontal support down here around 84, but I think this thing's playing catch up to the downside, maybe what some of the other retailers didn't get to the upside over the last month. And that's it for today, guys. Good luck out there.